Hello and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Wednesday, December 15th, 2021, and I'm pre-recording this Trading Places Live for Thursday, December 16th. Futures currently are showing a continuation of the rally that we saw this afternoon after the Fed meeting. Currently, we have Dow Jones futures up 34 points, S&P 500 futures up 6, NASDAQ futures up almost 30. So on a relative basis, we are seeing a little bit of strength in NASDAQ futures, and that is a continuation of what we saw in the final 2 hours today. A lot to go over, and there's a lot of different ways to interpret this. I would say one thing, I talked about the possibility that we'd see a relief rally. I think the fact that we've got these two inflation reports behind us, the CPI from last Friday and then the PPI from Tuesday, along with this Fed meeting and what the Fed was going to do to combat inflation and so forth. I think just the fact that it's behind us, I think a lot of folks decided to put some money back to work. But we're going to talk about all that. Let's first go over the agenda for today. So we're going to start off with the daily market recap. Then we'll jump into talking technically, break it down, inflation or no inflation, earnings spotlight, and the 3 you must see. Got a lot to cover, so let's get into it. If you are new to earningsbeats.com, I just want to point you over to our website. If you go to earningsbeats.com and then scroll down, you'll see we have a free newsletter. So you can simply type in your name, email address, hit that subscribe button, and you'll be set to go. I publish a newsletter there Mondays, Wednesdays, and Fridays, so 3 times a week. It's a very simple read, usually just a couple of paragraphs and a chart. Things that we really like to focus on at Earnings Beats. So we're going to be talking about relative strength, earnings, gaps, candlesticks, and so forth. But I think it's a great way to learn more about us. Also, when we do any free events, we normally will reach out. Not normally, we do. We reach out to our community of Earnings Beats Digest subscribers. There's no credit card required on this at all. You can unsubscribe at any time. We'd love to have you. So go to earningsbeats.com and scroll down and make sure you sign up for the newsletter if you haven't already. All right, let's jump into the daily market recap. It was a wild, wild, wild day on Wall Street on Wednesday. It looked like things were, just continuing as they have over the past several days. Market was selling off. 2 o'clock, we got the Fed announcement, and then things started to go kind of crazy. We got an initial jump, then we pulled back. It looked like the selling was going to accelerate, and then we had a big rally into the close. I'm not sure it's going to stick, but in the short term, it at least felt pretty good from a long perspective. We'll take a look at some charts. Again, there are a lot of mixed signals still in the market. I don't think that this is a market where you just take, let your guard down and just go all in. I think this is still a market that could be choppy for a period of time, but again, we'll talk about some of that in a bit. The Dow did finish up 383 points, the S&P 75 points, the NASDAQ 328 points, so a big, big rally there. Mid caps up 28 and small caps up 17. So on a relative basis, the NASDAQ was your big winner, gaining more than 2%. Technology was a big reason for that. Technology jumped 2.65%. Healthcare up over 2%. Utilities 1.6%. Real estate almost 1.5%. The only sector to lose ground on Wednesday was energy. Energy was down about 0.5%. So when you look across the board here, I see 3 defensive groups. I mean, I know that, the rally that took place in the last couple of hours. Technology went speeding by the defensive groups and into that number 1 position. But the other aggressive sectors weren't able to overcome the defensive groups. And I've got a couple of charts that I'll be talking about a bit later in the show dealing with this. But like I said earlier, it was at least a good feeling to see the buyers jumping back in. We saw some bounces off some key support levels, especially when it came to the small cap growth stocks. Those of you who are members at Earnings Beats and received my daily market report, I had posted the Dow Jones U.S. Small Cap Growth Index, saying that we were at key support. We bounced right off of it and had a huge rally. So that was good news. But let's keep moving here. Got a lot to go over. 10-year Treasury yield. All right, so the 10-year Treasury yield, you can see, had somewhat of a muted response. I mean, in the FOMC statement, the Fed talked about raising interest rates 3 times in 2022, and the tapering is going to be sped up. So the tapering of the bond purchases. You know, of course, the Fed's been buying bonds to keep interest rates low to stimulate the economy. Well, they're going to reverse it. And they're going to reverse it quickly, more quickly than they had previously discussed doing it. And part of that is to, to deal with inflation. You want to spur the economy, but not to the point where you really trigger a problem with inflation. So that's the reason that, they're talking about speeding up that tapering process. They're going down to purchasing, I think they said 60 billion in bonds over the course of the next, I think that was in January. And then they're going to go down by, I think, 20 or 30 billion. I'd have to go back and look now. I want to say it's 30 billion. I think they went from 90 to 60, and they said they were going to keep that pace up. So if they do, they would stop their bond buying in 2 more months by March 1st. So that's going to be really interesting to see how this all plays out. They did, of course, play that little wild card and say, well, if the economy starts to struggle again, we may rethink these strategies. So, of course, the Fed's always going to throw that out there because that's, their mandate. Their mandate is to maximize, they want full employment, and then they want to stabilize prices. So it's really a 2-pronged attack. But anyway, 10-year Treasury yield up only 2.5 basis points after the Fed comes out and says, hey, we're going to slow down our buying of bonds, and we're going to raise rates 3 times next year. I would have thought there'd been a lot of folks selling bonds. And if you believe inflation's a problem, you also would want to sell bonds. I mean, who wants to hold a bond that yields 1.46% when we've got, right now the headline number on inflation is, up near 10%. So makes no sense to hold a bond. So the fact that, the bonds are not selling and the yields aren't going up, that's part of the confusing part of this. And like I said, everything's still kind of jumbled and mixed right now. And the pandemic from 2020 is not helping. It's really muddied the waters in terms of trying to look at these different areas and what's happening in one area and why something's not happening in another area. All of this, I think, is being impacted by the pandemic in 2020 and the way that this has all been playing out. Anyhow, on Thursday, got a lot of economic reports coming out. November housing starts and building permits will both be out. Looking for a little modest increase in November in both of those numbers from October. Initial jobless claims last week, 184,000, looking for that to bump back up to 200,000. The December Philadelphia Fed Manufacturing Index, November was 39. We're expecting that to drop back to 28.8, still a pretty high number. November industrial production expected to rise 0.7%. October rose 1.6%. So even though we're looking for an increase, it is coming down from what we saw in October. November capacity utilization, 76.4% in October. Now looking to move up to 76.8% for November. We'll see how all those come in the morning when we get that, when we get the economic news coming out. But looking at the 10-year Treasury yield, I just, I continue to see this double top up around 170. And then, of course, 175 was the high back in March. To the downside, that recent low, 134. I think that's our range for right now. I would expect, given this news and rate hikes and so forth, and to battle inflation, I would think you'd want to sell bonds and that would send the yield higher. We're just not seeing it just yet. So this is something I would want to continue to focus on as we move throughout the balance of 2022. Only a couple weeks left, by the way, or 2021, I mean, and then into 2022. All right, let's move on to talking technically. First up, I want to just take a quick look at the S&P 500. It is important to note that historically, the second half of December is much better than the first half for the S&P 500. And this is based on data going back all the way to 1950. So we're talking about 7 decades worth of data. The first half of December, the S&P 500 from December 1st to the 15th has an annualized return of 2%, just under 2% since 1950. The second half of December, the S&P 500 has an annualized return of 35.79%. So December historically has been a good month for the market, and most of that strength is in the second half. So was the move today, kind of jump starting what we normally see second half of December, Santa Claus rally? Time will tell, but history definitely favors the bulls as we move into the second half of this month. Continuing to look at the S&P 500, though, I want to break this down. Now, this is a 1-month chart of the S&P 500, 1-month hourly chart up here on top. Then we have healthcare relative to the S&P. It's been moving higher for the last week or a little over a week. Consumer staples been moving up the last week. Real estate moving up for about the last 3 days. Really been moving up close to almost the entire month, to be honest. Real estate's been performing very well. Utility, same thing. Utility's been going up. Now, when the market struggles, this isn't unusual. It's if the market breaks out, we want to really watch these 4 defensive groups that I just talked about. Because if we do break out and we start to move higher here into the second half of December, do the defensive groups lead? If they do, that is not good for the market. That tells me that professionals are rotating, using the strength to rotate out of the aggressive areas and into the defensive areas. So watch that. Now, if the market pulls back, it's normal for these groups to lead. What I'm saying is if we break out and the S&P 500 is churning, trying to go higher, and you see these 4 relative charts going higher, that would bother me a little bit based on everything else that's going on in the market right now. Now, these bottom 3 charts, first one is, technology relative to the S&P 500. We saw the big rally at the end of the day. Consumer discretionary, not so much. We had a little bit of a rally. And then if you look down here at the bottom, this is consumer discretionary versus consumer staples, which over the course of last month, we've seen this deteriorate, which again is kind of normal when the market's weak, when it's either selling off or when it's consolidating. This is not unusual at all. But when the market starts, moving to the upside, we really want to see this ratio start to move higher. So these bottom 3, if the market strengthens, we want these bottom 3 to keep moving up, and these top 4 right here to keep moving down. That's what we saw in the final couple of hours, and that's what we need to see continue if the S&P 500 continues to strengthen. So I just wanted to point all of that out. All right, let's move on to break it down. Oh, actually, before we move to break it down, let me tell you one more thing. Here's the 10-year Treasury yield. Here was the move up after 2 o'clock today. So we did get a little bit of a rally in the yields to the upside, but we came right back down. We got up to 1.485, and then right before the close, we were back down to 1.455. There just wasn't that much of a move. This one will be interesting to watch on Thursday and into the end of the week as well. All right, let's move on to break it down. First off, healthcare, big breakout right here. So I wanted to take a quick look at healthcare to see what areas of healthcare, what's driving this. So healthcare overall, the sector's moving up, but not everything in healthcare is moving higher. So let's take a look at what's moving this index or this sector. We'll start off with healthcare providers. I think this is the big reason why we're seeing healthcare going right now. Healthcare providers have really moved up. This is a relative chart. This top part right here, this is a relative chart to the S&P 500. This PPO, this is a relative PPO. So this is telling us the momentum of the relative strength of healthcare providers. It's been negative, but it's about to go positive. That would be an interesting development to watch. Also, you can see this is the absolute chart of healthcare providers. We've been in an uptrend, but we broke out above this sideways consolidation, went back, tested the breakout level, and then broke out again. So this is clearly trending higher, relative strength building. I think healthcare providers is a really nice area right now within the healthcare sector. How about medical equipment? Well, for the last 3 months, on a relative basis, medical equipment stocks have been underperforming the S&P 500 by a wide margin. The relative momentum accelerating to the downside. Right now, we made a big breakout above the April high, but we're just in this little channel working our way back down on an absolute basis. Until we break that channel to the upside, I would be really careful with medical equipment. Next up, pharmas. So pharma's been downtrending for a while, but this has been a big move here so far in December, just through the first 2 weeks of the year. Maybe it's because the first half of December, normally we don't do as well, and maybe there's a little rotation into pharmas. I would watch this, though. If we can continue to stay above these moving averages, that would bode well for pharmas in the near term. The fourth area within the healthcare group, medical supplies, kind of like medical equipment area, you can see breaking back, in this case, to a relative low that we had not seen since back in September or even August of 2020. So really falling apart here on a relative basis, medical supplies. Now, that's the relative strength. Absolute strength, we made this breakout just below the 1400 level. And so when we've pulled back, we've been holding 1400. I think as long as we hold about 1375 to 1400, I think the group is fine. But not everything can lead at the same time. So after breaking out and leading back in July and August, we've been consolidating and lagging since then. So this group's not broken. When you look at the relative strength, you got to be careful. I would be looking at the absolute chart as well. The absolute chart's fine, but relative strength is weak because here we've backed off of the recent highs from 3 months ago, while the S&P 500 is back up near its all-time high. That's why we're seeing that relative strength, or excuse me, relative weakness and absolute consolidation. The last one, biotechs. Biotechs, if you look, we broke out above the 2750 level. We went right back down, tested 2750. Now we're starting to turn up. We're starting to see some relative strength. So it looks like biotechs are starting to provide a little bit of leadership, although we are still well below these downtrending moving averages. So I think outside of maybe just a little short-term pop, I think we're probably going to consolidate for a period longer, which likely means another rollover in the relative strength and maybe a new low coming. We'll see. All right. What I would do then is once I get to this point and I think, okay, well, now I've got my the areas that I want to, concentrate on. One thing you can do is go into the dashboard and over here under member tools, scroll down till you get down to summary pages. And at the bottom of that, you're going to see scooter reports. What I would do, I mean, if you just want to get maybe a quick sense of some stocks that might work for you, this comes up in scooter order and it's large cap. So one thing you might do is just type in health care providers, and it will give you the highest scooter ranked healthcare providers. And then you can simply go and look at the chart. So for instance, Quest Diagnostics, just broke out. So here's a great looking healthcare provider chart. Now I would prefer to get in on a 20-day test. I think when you start getting in after it's already made a big breakout like this, you got some risk to the downside to the 20-day. But you can see here when it went up and approached that recent high, when it pulled back, it hit that 20-day and bounced right off of it. That's what I would be looking for. Keep these charts in mind, but look for solid reward to risk entry points, which for me in an uptrending stock like this would be the 20-day. All right, let's keep moving on. So how about inflation or no inflation? I mean, what do we have here? I mean, you look at the numbers and clearly you have inflation. So I'm not going to, tell you that there's no inflation. I mean, everywhere you go, and I wrote this article. This was just on December 11th, so it was just 4 days ago. I'm not here to tell you that there's no inflation. There is absolutely inflation. We've got a lot of demand and supply is still ramping up. So it's part of it is the pandemic, the fact that supply, the supply chain, you've heard a lot about supply chain issues. We just don't have enough supply to meet all of the demand that's, we've seen throughout 2021 and probably are likely to see in 2022. But the supply will slowly build and build and build until we'll get there. But in the meantime, if you got more demand than you've got supply, that's economics 101, that's inflationary. And that will normally send prices higher. And that's what you see almost everywhere you go, whether it's a grocery store, Home Depot, whatever, you're going to see higher prices. So in the short term, we have inflation. The problem, the stock market worries about long-term inflation, like we can't get it under control inflation. I don't think the market is telling us that that's a problem right now. And I went through this article and I said to watch for three things: gold relative to the S&P 500, the US dollar. Inflation eats away at our currency, so the US dollar should weaken if inflation's a problem. And then growth stocks versus value stocks. Growth stocks, their valuations are really built on this whole concept of future earnings growth and accelerating earnings growth. And that earnings growth combined with low interest rates, when you discount those future earnings and future cash flows back into present value terms, accelerating growth really increases market caps, and low interest rates also impact that. Now, if you get into an inflationary environment, number one, inflation is going to eat away at those future earnings. So inflation right away is going to start eating into the market cap of growth stocks. And we've seen that throughout 2021. Growth stocks have underperformed value stocks throughout the year. And the main reason is that we've seen these inflationary pressures. When inflation starts to come back down again, in my opinion, we are going to see an explosion in growth stocks. Now, I know the Fed said they're going to raise rates 3 times next year. I want to see it. I don't believe it's going to happen. I think we might get the first one and maybe even the second one. But I think by the second half of next year, I think the inflation threat's going to be coming back down. I think the economy will be strong, but I don't think it's going to be the imbalance that we see right now. I think supply will have had time to catch up. And so I think interest rates will moderate. And even if they do go higher for a period of time, like the 10-year Treasury yield, if it does go up, I think it'll come back down or at least consolidate. And that combined with inflation coming back down, I think sends growth stocks higher. But growth stocks tend to struggle during inflationary periods. And that's something that you have to be aware of. So what I wanted to do is, since we had the, the announcement, the 2 o'clock announcement, I wanted to look at, a little bit of this, take a look. And so the first thing I wanted to point out was gold. And when I first saw this, I was thinking, oh my gosh, look at the spike in gold. This was at 2 o'clock. So initially, when the news first came out, we saw gold tank, and then we saw gold explode back to the upside. So ordinarily, I would think, well, maybe I should be a little concerned about that. And then I took the next step, because it's really gold relative to the S&P 500. Is gold outperforming the S&P? Because if it is, that means Wall Street is choosing gold over stocks. And if we're looking at gold as an asset class being favored, that would start to lend credibility to the whole inflation argument. But watch what happens when I change this to gold versus the S&P 500. You see gold moving up, but look what happens on a relative basis after 2 o'clock. Gold goes down, it comes back, tests where it was prior to the announcement, and by the end of the day, we were back down near the low of the day. So don't be confused by the fact that gold went up. Yes, gold went up, but the S&P 500 exploded to the upside. So once again, on a relative basis, gold is underperforming. This is telling me, ignore all of this inflation hype. Yes, we have inflation, but it is not going to be a long-lasting inflation based on what I'm seeing right now. And that tells me you might want to be careful about parting ways with your growth stocks too early. I think they're going to rebound in 2022. Maybe they've started already. I'm not so sure. This is still a long way off from when I think inflation peaks and starts to roll back over. But the market does look ahead. So this is going to be an interesting development, growth stocks, over the course of the next several weeks to months. All right, running out of time here, but let's take a look at the growth stocks relative to the value stocks. So growth, this is large cap growth versus value. Big rally this afternoon, but it's only gotten back to where it was on Tuesday morning. So not sure what to make of that. Mid cap growth versus value, same thing. This relative ratio is back to about where we were when we started the day on Tuesday. But the one that I really liked was small cap growth versus value, because we actually went back up above where we had finished back on Monday at the close. So this one did a little bit better than the other two. And I'm feeling a little bit, more bullish about that, but we'll see whether or not it continues. All right, let's move on to earnings spotlight. Just a couple of stocks I wanted to go over real quick. Lennar came out with their earnings after hours on Wednesday and posted earnings of $4.36. Market was expecting $4.14. But this stock, if you look at it on a relative basis, has not been performing very well. This is the type of stock Wall Street, in my opinion, is avoiding. I think it likes other home builders better. Well, after hours, even though the Lennar beat, they're down 7%, more than 7%. So that's something to keep in mind. One other stock I wanted to show you, HEI. This is an aerospace stock. And this is a stock that's been doing pretty well among its aerospace peers, but aerospace has not been doing well relative to the S&P 500. So what I said a couple of days ago is aerospace really needs HEI or Heico to report strong numbers, because this is one of the leaders in the space. And if this doesn't do well, others are probably going to have problems. Well, Heico came out 62 cents versus 57 cents, and the stock was up 3.5% after hours. Now, that's not breaking out. We got a lot of work to do to get through 150, but it beats the alternative. And the one thing I do like about this chart right here, look at the AD line. If we gap up and then keep rolling tomorrow on big volume, we may see a breakout on the AD, something to think about. All right, let's move on to the three you must see. Just got three quick charts for you here. JD.com, first thing, it looked like we were moving higher. This is a weekly chart. Looked like we were moving higher. See how we were trending up above that 20-week moving average? Well, just recently, rolling back over. I'll flip it over to a daily chart so you can see the daily chart. Also, we had this uptrend going, and now the daily chart's rolling over. Volumes picked up on this move to the downside, but the AD line is staying up. So a little bit of a mixture here. I'd like to see the stock get back up above the 20-day before I'd be interested, though. Next up is NUE. This is Nucor Corp. This is a steel company. Did not like the false breakout on Tuesday, and then today comes down, but we did have a false breakdown. Very big volume. Stock was down 8.6%. It was the worst performer on the S&P 500. Price action's been going sideways, but it looks like the stock's being distributed. I did not like steel stocks back in August. I said this was an area I'd be very careful with. And it looks like Nucor, we've been seeing distribution for the last 3 or 4 months now. I would be careful, especially if we close back below 104. Watch this one. And then the last one I wanted to mention is Cisco. Cisco just quietly moving back up and breaking to a new high, up near $60. AD line looks good. Relative strength is okay, relative versus its peers. It was weak, but it's come roaring back here in the last month or so. Volume trends have been strong. As I mentioned, that AD line moving up. So we are looking pretty good here on Cisco. All right, that is it for me. I appreciate everybody tuning in. We're going to be running some evergreens over the next couple of weeks. So I won't be back on StockCharts doing another live show or even a recorded show until the first of the year. I want to wish everyone great second half of December. Happy holidays, everybody. Happy New Year. And I'll be back to you at the start of 2022. Happy trading, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.